Gold is in a mini squeeze. How do we know this? Because open interest has fallen by about 43,000 contracts since the price low of 25.44 on November 5th, was it? November somethingeth. And we've had a $134 rise since then. So contracts are closing, price is rising, which means that shorts are closing at a loss. This isn't a major gold squeeze, but it is a squeeze, which suggests to me that the bottom for now is in an intermediate bottom in gold, and it will keep going. Gold has sliced back above the 50-day moving average without even a shred of resistance at that line. We're back near 2,700. That's another piece of evidence that the bottom is in. But yes, the big news this week is Bitcoin, which has tagged its all-time high in gold terms at 37.2 ounces, just below its all-time high, I think about 37.4, but we're just about there, which means if this high is not broken through, we have a potential triple top in Bitcoin. Has Bitcoin surprised me to the upside? Of course it has.
In today's news recap, silver outshines gold with over 20% returns in 6 months. What is propelling it? Silver has given an impressive return of 20.25% in the past 6 months compared with gold's return of 10.29%. Silver sales witnessed a sharp spike in the recent weeks, especially ahead of Dantas. This year, investors not only bought it in physical form but also in the form of exchange-traded funds. Silver has given an impressive return of 20.25% in the past 6 months, compared with gold's return of 10.29%. Rating agency, in its report, said the total number of folios under silver ETFs increased by nearly 215% to touch 4.47 lakh in October 2024, up from 1.42 lakh in the same period. Last year, net inflows grew by 24% at 6,431 rupees in October 2024. As against 518 rupees last year. Silver ETFs registered an unprecedented surge, with the assets under management growing by over fourfold to touch 12,331 crore rupees in October 2024, up from 28,447 crore rupees in October 2023. It added, while gold ETFs have been in the market for quite some time now. Silver ETFs were launched as recently as 2022. Ashwin Kumar, Senior Vice President and Head Market Data at IC Analytics, said, the number of silver ETFs, which stood at 8 in April 2012, has increased to 12 in August 2024. If domestic inflationary PR pressures and geopolitical instability continue to persist, then silver may continue to witness upbeat demand. The market may see the launch of more silver ETFs in the coming months as its role in investor portfolio diversification, investment, and management becomes more crucial. Silver prices are expected to remain attractive, as the expectation is that the U.S. Federal Reserve will continue to cut interest rates in the coming months, giving a boost to silver prices. Besides, geopolitical tension may prompt risk-averse investors to invest in safe haven assets, like silver. Demand for silver is expected to remain upbeat due to its usage in electronics and green technologies. Moreover, investors often prefer investment in silver for portfolio diversification, and it is often seen as a hedge against inflation. This apart cut in customs duty and change in taxation structure has made silver investment more attractive. Kumar said, now, before we dive back into the best clips, I've got a deal you cannot afford to ignore. Black Friday's here, and so is your chance to lock in ultimate online security with NordVPN. Listen up, this is especially for you stackers out there. Keep your data safe, stay anonymous, and grab this exclusive offer. 3 extra months free plus a 30-day money-back guarantee. Check the link in the pinned comment. Don't miss out.
Chart this week. I'm going to show you this chart in interactive in a second so you can get a better idea of what I'm talking about here. The black line is where we are in QT weekly, right? You see here is the latest reading. I think it's $43 billion down on the balance sheet. What is notable about this, first of all, is that we are at a rate here that we haven't seen since before they started slowing down QT in June. The Fed slowed down its pace of QT in June, but we're beyond that now. We're at 43 billion this week, and it really hasn't been higher than 43 billion any consistent way since QT started way back in 2021. This starts from the regional bailout, this chart here. We're going to go to an interactive chart right now, and I'll show you why I think this is pretty notable. You may recognize this chart from the one you just saw. So what I'm pointing out here is that QT, right, every time it's below zero, we have the balance sheet shrinking. Very rare circumstances, it's above zero for some accounting reasons or whatever. But generally, QT has continued since the regional bank bailout in March 2023 pretty consistently. We have here, this is the key. On October 9th, 2024, the balance sheet shrunk by 85 billion, and the next week by 7.556 billion, and then 9.876 billion, then 16 billion, then 19 billion, then 27 billion, and now this week 43 billion. So this is the first, second, third, fourth, fifth, sixth week of QT acceleration. Now, it's not just the Bank Term Funding Program that is causing this. The Bank Term Funding Program is being liquidated because rates are being cut, and the rate of the Bank Term Funding Program, which is the regional bank bailout program, those rates are steady, and as rates get cut, the rates of holding those loans to maturity become more expensive than refinancing those loans at lower interest rates, which the Fed is offering now because they've cut interest rates. So that is being liquidated. That's not the only thing going on here. There's a whole bunch of other accounting things going on at the Fed's balance sheet that even I don't understand. But what is happening here is that the quantitative tightening program is accelerating for 6 straight weeks, and the faster we go down, the faster the reverse repos will eventually fall to zero, and the faster we will get to the final banking crisis, which is still just around the corner. It's a very long and annoying corner, but it's still there. Anyway, we're going to continue with the slides here. The next one shows you the monthly rate of QT, how fast indeed we have accelerated. The black line is the rate, the monthly rate of QT that we're at now. Everything above that rate is slower than the rate we're at now, and everything below it is faster. So we're about the average of the monthly QT rate that we've been in since the regional bank bailout over here. That's where I started the chart, has re-accelerated to the average level that it's been at since the regional bank bailout took place. There's a little gold squeeze going on, a mini gold squeeze. How do we know this? Well, if you look at the open interest chart here, you will see that the green lines on the bottom have descended to, right now it's 498,000. This is 1 day delayed. It says 501 here. We're at 498. So we broke 500,000. And during that time, as this has been descending, it descended from about 545,000 to now 498,000, something like that. But I calculated it's 43,000 contracts. And in that time, the gold price has risen by $134, which means that short positions, the ones who hold the gold short positions on the futures markets, are closing their positions, and because of that, the price is rising. So these bullion banks are closing their positions into a rising price, which means they are losing money on them. Not that much money. They're not in desperate, dire straits or anything, but this is very indicative of a firm intermediate bottom here in gold. I don't think we're going to go much below that, barring the next financial crisis, which might very temporarily, ephemerally bring us below this, and that will be our final opportunity to get some real money before we have a hyperinflationary explosion. So even a mini short squeeze is encouraging in the gold price, and it looks like we're headed higher, back higher from here, and very soon we'll be back to old highs and past them.
Gold is experiencing a mini squeeze, with prices rising by $134 since November 5th, even as open interest in contracts dropped by 43,000. This indicates that short sellers are closing their positions at a loss, which suggests a firm intermediate bottom near $2,544. The recent rise saw gold break above the 50-day moving average, with ease signaling strong momentum as prices approach $2,700. Silver, on the other hand, has outperformed gold over the last 6 months with an impressive 20.25% return compared to gold's 10.29%. The popularity of silver ETFs has surged, with assets under management increasing more than fourfold in demand, driven by inflation hedging, geopolitical instability, and its role in green technologies. Bitcoin is also making headlines, nearing its all-time high in gold terms at 37.2 ounces. However, there's a risk of a bearish triple-top formation if it fails to break through this level soon. Meanwhile, the Federal Reserve's quantitative tightening, QT, has accelerated for 6 consecutive weeks, with a $43 billion reduction in the balance sheet this week. This trend could foreshadow banking instability as the financial system adjusts. In Japan, 10-year bond yields are nearing a key resistance level of 1.08%, which, if breached, could further weaken the yen due to its bond-backed currency structure. In India, despite high gold prices, festive buying remains strong, supported by robust demand for jewelry and ETFs. The reduction in smuggled gold following import duty cuts has further boosted official channels. Overall, gold and silver remain attractive assets amid ongoing inflationary pressures, geopolitical tensions, and their increasing importance as hedges and technological resources. Both metals are poised to continue their upward trajectory in the near term.